Hello guys, so as you may know, I am also a market maker apart from doing these videos. So I will sort of explain you with a client example how does market making work and what are the basic tasks that we have. Let's take this token as an example. What's the first thing I have to consider is how many markets there are. So as we can see, we have 1, 2, and 3 central exchanges, but we have 3 liquidity pools in the central exchanges as well. And actually, what is this? L Bank. This is another central exchange. Okay. Yeah, and it looks like there is some sort of market making going on here. Okay, so this client is managed by Godbit currently, but we will soon do the market making for them. And what are the main functions? So as you can see here, if we go to Maxi order book, the Maxi order book is erased. Wait, let me put less decimals. It's a bit weird. These order books, they normally don't provide liquidity so asymmetrically. It seems like what they're doing now is putting support and resistance levels, but this is not the norm. The norm, maybe here. Yes, as you can see, this is the norm from market making. So we have a staircase of liquidity in both sides, which means that the price will move from many small bits. In fact, if for example your goal is to pump the price of a token, you shouldn't do it all at one market sell. You should do it progressively. So instead of buying $1,000, you buy $100, $100, $100, because when you buy $100, the order book will move up. But if you do it instantly, it won't. So what is your goal? Is it to fill your bags early? Or is it to move the market making algorithm upwards? Okay, this is how it works. Second goal of a market maker. I'm talking from my own perspective, from my own algorithms. I believe one of the most important things for doing market making for this kind of coins is volatility. When you invest in a meme coin, you want to see these numbers, at least a 10% increase or a 10% decrease. That's that's why you're in meme coins. You assume the risk. You don't want something that acts like Bitcoin that maybe it raises 3%, 5% at most. So how do we make a market both stable and volatile? Okay, I'm gonna take out this beautiful tool. I'm not a good drawer, but I'll try my best. So this is the order book. This is the order book. And obviously this is the green orders. And these are the red orders. Now, there is some metrics for risk management, because as a market maker, we don't want to support any price level unless we do. Normally you want to be a fair market maker. Sometimes you can draw supports. You can put supports and resistances, so the price goes like this. Also, you can paint the chart with your own supports and resistances, but ideally we don't do this. unless you have a strategy, a marketing strategy to couple the supports with, you know. So what usually happens is we check out the VPN, the VPN volume, volume synchronized probability of informed trading. Summarized, we are trying to calculate the imbalance between the buys and the sell orders, and this data we can gather it from the order book. From here, for example, we can see that 60% of the trading is buys and 40% of the trading is sells. So on a normal scenario, if we had 50-50, we would have the same amount of volume both here. So let's say we would have $1,000 in this side, and the $1,000 would be spread in a staircase. Okay, so we would have maybe 10, 20, 30, 40, etc. until we reach the whole 1,000. Now, what would happen if, for example, also this would be at the same level. What would happen if we had 60 and 40? Well, this is 60% buys, okay? So, as a market maker, we want both a volatile environment and an environment where the price is moved by the retail. So, we let the retail move the price. What does it mean? When there are 60% buys and 40% sells, we should respect this. Also, this is yeah, okay. I thought I wanted to verify it was the volume, because we have to take into account the volume, not the amount of trades. Okay, so what would we do here? We would put a slightly different ratio. Maybe here we would modify it accordingly. We would do maybe 1,200, and then here, no, sorry, this is the sales, so we would do less sales, 800, and more buys, because the market is what it's doing, you know. And by doing this, we let the price move up, okay, and it's a more volatile scenario. So this is volatility one. This is one of the things we do as market makers. We play with the volatility of the token, and we also play with the supports and resistance. Okay. Second thing a market maker would do, arbitrage. How does arbitrage work? What is arbitrage? Well, if we go back here, we will see different opportunities. We will see here we have a discrepancy of 0.0005, but how much liquidity is extractable? You know, you cannot just buy on MEXC and sell on BingX. We have to check not the price. we have to check the bid and the ask, meaning that which one was cheaper. Well, we can see it here. This one is cheaper on MEXC. So if we were to buy now here, we would be buying at 15.29. Whereas if we would be selling here, we would be selling at 15.15. So this is not a good tool to do arbitrage. The API of CoinMarketCap doesn't work. You need to extract data from the order book, both from here and from here. And there is very little short time that there are these price discrepancies that you can extract alpha from. And even so, imagine we have 1 cent difference or 2 cents difference. If I were to buy here low to sell here high, the process would be buying here, withdrawing, commission of $1, putting money here, and depositing. Well, this is too long, and it's not efficient. It's not efficient. So what do we do as market makers to have the advantage? This is why you need liquidity always. You need to allocate, let's say, $200 in each exchange and 100,000 tokens. Okay, so we do this because at the moment that there's an arbitrage opportunity, we don't need to move funds between exchanges. We can just, for example, buy here, back, we buy, and then we sell here with the funds that we already have. We do it automatically with oracles, So let's say we have an oracle that tracks the price here and the price here. Okay, let's say here it's +1 and here is -1. So there is an arbitrage opportunity. So once this is detected, this account is related to one wallet and this account is related to another wallet, and the oracle will be tracking the price, let's say 1, and here we will say 2, and it would indicate that this wallet over here should be selling and this wallet over here should be buying until the price moves to until the price moves to 1.5. This is arbitrage and the most basic of market making. If you want me to make a more advanced part where we can talk about MEF bots, we can talk about futures, liquidations, we could talk about carry trade, and much more. I will make a second part if this video gets enough likes. Thank you very much.